Good morning and welcome to the Small Business Development Center's Accounting Basics webinar. Today we have Maria Delio, CPA, who's going to be talking to you about some of the accounting basics that we at the Small Business Development Center think are important. Thank you for coming, Maria.
You're welcome, and thank you. Good morning. During this presentation this morning, you're going to learn the basic accounting equation and how it relates to understanding balance sheets and income statements. We'll gain some knowledge on debits, credits, and your trial balance. Assets and expenses are typically reflected as debits in the balance sheet and income statement, and liabilities, income or revenue, and equity are typically reflected as credits in those statements. A trial balance is simply a listing of all of the accounts you are using with their balances, and the debit and the credit column in the trial balance should agree. What is the accounting equation? The accounting equation is how the balance sheet is reflected. A balance sheet is just that. It should balance. So basically, your liabilities should equal your assets less profit or equity, or another way of showing that is that your profit or equity equals your assets minus your liabilities. Here we have an example, first off, of a trial balance. And again, you can see what this does is basically lists all of your accounts that are in use. In this example, we have a limited number of accounts, but the debit column, which is the assets and the expenses, total $30,000, and so does the credit column, total $30,000, which is showing your liabilities, the stock, and your revenue. So anytime you're looking at a trial balance or all of your accounts, the totals of your debits and credits should equal. Let's start with the income statement. There are several names that are used for an income statement. You might hear a profit and loss statement or an earnings statement. And one thing I do want to mention is when we're looking at an income statement, you should understand that it is cumulative. So if we're looking at an income statement as of December 31, it would include all of the activity, your income and expenses, from January 1 through December 31. Here we have an example of an income statement. You can see that our revenues, which is all of your income, shows in the credit column for $10,000. All of your expenses, which in this case are rents, salaries, supplies, and utilities, are in the debit column. Those total expenses are $6,000. So our income of $10,000 less expenses of $6,000 leave us with net income in the credit column of $4,000. Now, there are three parts of an income statement. There is the revenue, which we just showed in the credit column. Those are all of your sales or other sources of income. There are the expenses, which are in the debit column, which is anything that you've spent money on in relation to your business. And then we have the net profit, which is our bottom line, which rolls into the retained earnings section of our balance sheet that we'll show you later. Again, in discussing revenues, we basically have a couple of different names that we can call it. These are our net sales or our gross income. And both of those, again, show up in the credit column. And in a double entry accounting system, which means that debits and credits must balance, if we are increasing our revenues, we are reflecting that as a credit. So credits increase revenues. Any kind of a debit would decrease your revenue. We have our expenses, which are, there's different categories of expenses. There are the cost of sales, and cost of sales generally reflects what it costs to sell one item, so or to generate revenue. So what you're spending to sell your product directly is considered the cost of sales. We have selling expenses, which can be like a sales force or any other type of advertising cost that we may incur. There's general and administrative expenses, and there's any other special expenses that may be incurred. The net profit / retained earnings is, the net profit is also referred to as net income, operating profit. We could call it pre-tax profit. If your company is subject to tax, you would take your pre-tax profit, subtract out your taxes, and then you've got your after-tax profit. Gross profit, it's worth mentioning, is your gross revenues or income less the cost of sales that I discussed earlier. So gross revenues less what it costs to directly produce and sell your item leaves you with the gross profit. What we've got next is the balance sheet. And the balance sheet consists of your assets, your liabilities, and your equity. Assets can be current or fixed or long-term. So current assets are assets which we can expect to be turned around within a year's time. So current assets are fairly liquid. We've got cash, accounts receivable, and inventory. Those would be considered current assets. Equipment is considered a fixed or a long-term asset, and those types of assets are items that you will expect to recognize a benefit from over a period of time. We also have current and long-term liabilities. Current liabilities are liabilities that expect to be paid within a year's time. So your accounts payable, as shown here, would be considered current, while the loan, also shown, might be considered long-term because it's spread out over multiple years. So the assets of your balance sheet are typically reflected in the debit column and reflect everything that is of value or worth to you or the business. The liabilities reflected in the credit column is anything that you must pay out or you are liable for. The equity section reflected below kind of balances the assets and the liabilities and shows the retained earnings and in the common stock or any possible additional paid-in capital there may be. Now, the retained earnings is essentially the retained earnings, profits, and losses of your business over time. It's also worth mentioning that the balance sheet reflects a snapshot of these accounts at one day in time. So your cash balance would be the balance as of that day. So for this example, we have year ending December of 2015. We assume December 31. So on December 31 of 2015, your cash balance is $10,000. You have receivables of $4,000, an inventory of $4,000, and equipment of $6,000. The same goes for your liabilities. And again, the retained earnings is the only cumulative number in the balance sheet and does reflect the retained earnings, profits, and losses of your business over time. And again, the debits and the credit columns do equal. So your total assets are $24,000, your total liabilities are $8,000, and your equity is $16,000, which equals $24,000. And again, as I had mentioned earlier, any increases in your assets will be reflected as debits. If your assets decrease, you're going to credit them. And the opposite is true for your liabilities. Increases in liabilities are reflected as credits. whereas decreases are debits. We just discussed the three parts of a balance sheet: the assets, the liabilities, and the equity. Our assets typically, like I had mentioned, are current or long-term. Your current type assets, again, are your cash, receivables, and inventory, items that you expect to be turned over within a year. The long-term or fixed assets are items like land, buildings, and equipment that expect to be providing a benefit to you over a period of time. And there are other assets which you may have, like prepaids or investments. Again, our liabilities consist of short-term and long-term liabilities. Loans are typically long-term liabilities, which will be owed over a period of time greater than a year. Your accounts payable are current liabilities, which we hope to have paid within a year. And the salaries is here just to reflect that you can accrue salaries that are due potentially to employees that maybe at year end have not yet been paid. The equity section consists of capital stock, which is the value of the stock when the corporation was created, and also the retained earnings, which again is the retained earnings, profits, and losses of your business over time.
Thank you, Maria. I really appreciate you coming in and talking about debits, credits, and getting us started on the financial statements that we want to look for. We do a workshop called Get Behind the Numbers, Understanding Your Financial Statements, and that's where Maria will go into more detail about how you can use those statements to make good decisions for your business. Thank you for coming, Maria. We appreciate your time and your effort.
Thank you very much.